Resolution 42. Discover Foremost. Quote Foremost to cross-sell home, auto, motorcycle, boat, and seasonal or landlord properties and grow your business. Foremost for you. ForemostAgent.com.
The soft market is turning. Perhaps not dramatically, but it is turning, says Jerry Sullivan, chairman of the Sullivan Group in Los Angeles. Can customers pay higher rates? What role should brokers play in the transition? Sullivan gives his view in this interview with Insurance Journal from the recent WIAA Insurance Industry Roundtable, starting with why and where commercial rates appear to be flattening.
It is true that rates appear to be flattening, and one of the things that you have to be careful with is that different people measure rates in different ways. So there are several different firms that do that. Market Scouts, one, does an excellent job. CIAB, also, Council of Insurance Agents and Brokers, has been running a track record on commercial rates. But what's abundantly clear is that since the first quarter of 2004, U.S. property casualty commercial rates have been dropping significantly. Now that began to taper off a little bit within the last 6 months, 9 months, something like that. And Market Scout's data shows that rates are holding their own now. They're not dropping, they're not increasing. CIAB's most recent measure shows a slight uptick in the last quarter. But the reality is the rate situation varies by type of coverage, it varies by geographic area, but on balance, pricing has been, for U.S. property casualty commercial, so decimated the last 4 or 5 years, 6 years, that a change has to come about, and that's beginning to occur. There's a whole series of things that are leading to that. I mean, first of all, if you take those cuts in rates over this period of time, it's almost a 50% reduction in commercial rates here in the United States. The fact is, in 2004, commercial rates were not 50% above where they should have been. So what's been happening is balance sheets and income statements are being negatively impacted for insurance companies because of what they're doing. And that's beginning to show up. Combined ratios are beginning to increase, driven largely by loss ratios, and boards of directors of insurance companies are beginning to recognize that. But they're also having to deal with investment income is down. It's been down for a period of time, and it's going to stay down for a while. That's impacting on how they operate. Over a period of the last 3 or 4 years, where they've been having some difficult times because of this cut in pricing, they've been able to offset it to some extent by savings in loss reserves that they've had up. And by all the measures you see most recently, AM Best, Fitch, Moody's, and others, US P&C has gone about as far as they can go in taking excesses out of reserves. So that's off the books for them. One of the really big issues that's significant in U.S. property casualty is cash flow. U.S. property casualty insurers have, for 6 of the last 10 quarters, generated negative cash flow. That's a sure sign of a change in the marketplace.
As Sullivan says, the conditions are such that rates must change. But if insurers are in a position where they are saying, we have to raise our rates, who's going to pay the higher rates? Are buyers willing or able to pay more? Sullivan says insurers and brokers have to take a broader approach than just focusing on price.
Well, the broker's role is twofold. One, they need to go to the insured, make sure the insured knows what's happening, why this is occurring, what's happening to the risk takers. Because whether the insured likes it or not, they need the risk taker when the losses occur. And unfortunately, they do occur. And so they need a healthy risk taker, at least reasonably healthy. So getting more rate per exposure is important. And we need to help the insured understand why what's happening is happening, and then help them understand their insurance program, how they can adjust it in a manner where they get the necessary coverages that they need to run their business. Because at the end of the day, that's what this is all about. But not have to pay more premium, or at least not dramatically more premium. And that's where this is all going to be ultimately heading. There is one other factor on the risk takers that has to be looked at, and that's the number of catastrophes that they've had to deal with worldwide. It has been dramatic the last 18 to 24 months. This has taken a lot of money out of a lot of insurers, particularly hitting reinsurers, who in turn will be impacting on the primary insurers that insurers deal with every day. So we are in a process of a market change. It's occurring as we speak.